Have you noticed how one headline suddenly captured the attention of investors around the world? Japan reportedly sold around $30 billion worth of U.S. government bonds in what has been described as the biggest sell-off in 4 years. At first glance, this may seem like just another financial headline. But what if this move is sending a much bigger message about the future of the U.S. dollar interest rates, gold and silver? Today we break down exactly what happened, why it matters, and why every precious metals investor should be paying very close attention. Japan is not just another country participating in the global bond market, it is one of the largest foreign holders of US Treasury securities. For decades, Japan has invested hundreds of billions of dollars into US government debt because Treasury bonds have long been viewed as one of the safest and most liquid investments in the world. When a country like Japan makes a significant move in this market, investors everywhere start asking questions. Why now? What changed? Could this become a larger trend? Most importantly, what does it mean for gold and silver? To understand the importance of this story, we first need to understand how the Treasury market works. When the United States government needs to finance spending, it issues Treasury securities. These include Treasury bills, Treasury notes, and Treasury bonds. Investors around the world buy these securities because they are backed by the full faith and credit of the U.S. government. Foreign governments, central banks, pension funds, insurance companies, banks, and private investors all participate in this enormous market. The Treasury market is considered the backbone of the global financial system. It influences mortgage rates, business loans, corporate borrowing, consumer credit, and nearly every major financial asset. When demand for Treasury bonds rises, prices usually increase while yields move lower. When investors sell large amounts of Treasuries, prices fall, and yields often move higher. This relationship between bond prices and yields is one of the most important concepts in finance. Now imagine what happens when one of the largest foreign holders begins reducing its holdings. The immediate concern becomes whether other large investors might eventually follow. Even if they do not, markets often react strongly simply because expectations begin changing. Japan has several reasons why it may choose to adjust its Treasury holdings. One reason involves domestic financial conditions. If Japanese interest rates begin rising, investors inside Japan may find local government bonds more attractive than they were during years of extremely low rates. Capital that previously flowed into U.S. assets may gradually return home. Another factor involves currency management. Japan closely monitors the value of the Japanese yen. If authorities decide they need to support their currency, they may sell foreign assets, including Treasury securities, to obtain dollars, which can then be exchanged for yen. This process has occurred before during periods of currency volatility. There are also broader portfolio management considerations. Large institutional investors constantly rebalance their holdings based on changing interest rates, inflation expectations, economic growth, and financial risks. Selling part of a Treasury portfolio does not necessarily mean investors have lost confidence in the United States. Sometimes it simply reflects changing financial conditions. However, markets rarely focus only on the technical explanation. Markets focus on perception. When headlines report the largest sell-off in 4 years, many investors immediately begin asking whether this signals something much larger. That uncertainty alone can create volatility. The Treasury market directly affects the Federal Reserve. Although the Fed does not control long-term Treasury yields directly, market conditions influence financial stability, borrowing costs, and overall economic activity. If Treasury yields rise significantly, borrowing becomes more expensive across the economy. Businesses may delay expansion. Consumers may reduce spending. Housing activity may slow. Government financing costs may increase. All of these developments eventually influence monetary policy discussions. Now consider what higher Treasury yields often mean for precious metals. Gold and silver generally do not generate interest income. When bond yields rise, investors sometimes shift money toward fixed income investments because they can earn higher returns while taking relatively low risk. That process can temporarily pressure gold and silver prices. However, the story rarely ends there. If higher yields begin creating economic stress, investors may once again seek safe haven assets. Gold frequently benefits during periods of financial uncertainty. Silver often follows, especially when investment demand expands beyond gold alone. This is why experienced investors avoid looking at only one variable. They study the complete picture. Another important factor is the US dollar. Treasury securities remain closely connected to the dollar because foreign investors often need dollars to purchase US government debt. Strong foreign demand can support the dollar. Changing demand may influence currency markets over time. A stronger dollar has historically created headwinds for precious metals because gold and silver become more expensive for buyers using other currencies. A weaker dollar often has the opposite effect. This relationship explains why precious metals investors watch currency markets almost as closely as they watch gold and silver prices themselves. Inflation also remains part of the equation. If investors become concerned that government borrowing continues expanding rapidly while debt levels increase, they may begin questioning the long-term purchasing power of paper currencies. During those periods, many investors diversify into tangible assets. Gold has traditionally served as the primary inflation hedge. Silver often attracts additional attention because it combines monetary characteristics with growing industrial demand. That industrial demand story has become stronger than ever. Silver is essential for solar panels, electric vehicles, artificial intelligence infrastructure, advanced electronics, telecommunications, medical equipment, and modern manufacturing. Unlike many industrial metals, silver also serves as an investment asset during periods of uncertainty. Very few commodities possess both characteristics. That makes silver especially interesting whenever financial markets become unstable. Now let us consider the broader economic environment. The Federal Reserve continues balancing two difficult objectives. It wants inflation to remain under control while also supporting sustainable economic growth. Interest rate decisions therefore depend upon incoming economic data. Employment reports inflation readings, GDP growth, manufacturing activity, consumer confidence, retail sales, and housing data all contribute to future policy decisions. Markets constantly attempt to predict what the Fed will do next. Sometimes expectations change several times within only a few weeks. Those changing expectations influence Treasury, yields the dollar stock markets, gold and silver almost every single day. This is exactly why one major Treasury headline can ripple across the entire financial system. Investors understand everything is connected. Bond markets influence currencies. Currencies influence commodities. Commodities influence inflation expectations. Inflation expectations influence Federal Reserve policy. Federal Reserve policy influences virtually every financial market. The recent Japanese Treasury sale therefore represents much more than one isolated transaction. It has reopened an important conversation about global demand for U.S. debt, future interest rates, financial stability, and the outlook for precious metals. The biggest question investors are now asking is whether this was simply routine portfolio management or whether it signals the beginning of a much larger global trend. That answer could have significant implications for gold-silver and the broader financial markets over the months ahead. Even if Japan's recent Treasury sale proves to be a one-time event, the market reaction itself tells us something important. Investors are becoming much more sensitive to changes in the global bond market than they were only a few years ago. Every major transaction is now analyzed for clues about where interest rates, currencies, and global capital flows may be heading next. One reason for this increased attention is the size of the U.S. national debt. Government borrowing has continued expanding over the years. As more Treasury securities are issued, the market needs enough buyers to absorb that supply. Domestic investors play a major role. The Federal Reserve plays a role during certain periods. Foreign governments and institutions also remain critical participants. If foreign demand begins slowing, the Treasury market may need higher yields to attract additional buyers. Higher yields can have wide-reaching consequences. Businesses may face higher borrowing costs. Home buyers may pay higher mortgage rates. Corporate investment decisions may become more cautious. Consumer spending may slow. Economic growth could eventually lose momentum. This is one reason financial markets monitor Treasury auctions so closely. Strong demand usually reassures investors. Weak demand often creates concern. Japan has long been one of the most important participants in this system. Its financial institutions manage enormous pools of capital. Small allocation changes by large investors can sometimes influence market sentiment far beyond the actual dollar amount involved. That is why headlines about Japan often receive global attention. The situation also highlights how interconnected today's financial system has become. A decision made in Tokyo can influence bond traders in New York, currency markets in London, commodity investors in Singapore, and precious metals buyers around the world. Everything is connected through capital flows. Now let us turn to gold. Gold has experienced many different market environments throughout history. It has performed well during periods of inflation, during financial crises, during banking uncertainty, and sometimes during falling interest rates. But gold does not move for only one reason. Successful investors understand that several forces often work together. If Treasury yields rise because economic growth remains strong, gold may face temporary pressure. However, if yields rise because investors become concerned about government debt or financial stability, gold may actually benefit as safe haven demand increases. This difference is extremely important. Markets always ask why something is happening rather than simply observing what is happening. Silver often behaves differently from gold. Because silver has significant industrial demand, it can benefit from both economic expansion and investment demand. If manufacturing activity remains healthy, silver consumption may continue increasing. If investors also seek protection from uncertainty, investment demand can rise at the same time. This combination has historically produced some of silver's strongest bull markets. Industrial demand continues growing in several important sectors. Solar panel installations remain elevated. Electric vehicle production continues expanding. Artificial intelligence infrastructure requires advanced electronics. Data centers continue consuming enormous amounts of electrical equipment. Medical technology keeps advancing. Modern communications networks require highly efficient conductive materials. Silver remains essential across many of these industries. Meanwhile, supply growth has struggled to keep pace. Developing a new mine requires years of exploration, permitting financing and construction. Existing mines often face declining ore grades. Production costs continue rising. Many silver mines operate as byproducts of copper, lead, zinc, or gold operations. This means silver output cannot always respond quickly to higher prices. That supply challenge has attracted increasing attention from analysts. Now consider what happens if investment demand begins rising while industrial demand remains strong. The available supply could become tighter. Inventories may gradually decline. Prices could become more volatile. Although no outcome is guaranteed, markets have repeatedly shown that tightening supply combined with rising demand eventually attracts more investor attention. Central banks represent another important piece of this story. Although central banks primarily purchase gold rather than silver, their actions influence the entire precious metals sector. Record central bank gold buying over recent years has demonstrated that many monetary authorities continue valuing physical assets as strategic reserves. This trend has encouraged private investors to examine precious metals more closely. Many ask whether silver could eventually receive greater attention as investors look beyond gold. The US dollar remains another critical variable. If foreign demand for Treasury securities changes over time, the dollar could experience periods of increased volatility. Currency movements influence commodity prices because most global commodities are priced in US dollars. When the dollar weakens, gold and silver often become more attractive to international buyers. When the dollar strengthens, precious metals sometimes face temporary resistance. Watching the dollar index has therefore become an essential part of analyzing precious metals. Economic data will also remain extremely important. Every inflation report, every employment report, every manufacturing survey, every retail sales release, every GDP update, and every Federal Reserve meeting has the potential to reshape market expectations. Sometimes expectations matter even more than the actual data. If investors expect aggressive rate cuts but receive only cautious guidance, markets can react sharply. Likewise, if inflation cools faster than expected, investors may begin anticipating easier monetary policy. Those expectations often influence gold and silver before official policy changes occur. Geopolitical uncertainty adds another layer. Trade disputes, regional conflicts, energy market disruptions, shipping challenges, and political uncertainty all affect investor psychology. During uncertain times, investors often seek diversification. Gold has traditionally been the first destination. Silver frequently follows as broader precious metals demand expands. The recent Treasury headline therefore arrives at a fascinating moment. Investors are already watching inflation, watching interest rates, watching central bank decisions, watching economic growth, watching currency markets. Now they are also watching whether foreign demand for U.S. government debt begins changing. No single event determines the future of financial markets. But every important event adds another piece to the larger puzzle. That puzzle now includes shifting global capital flows, changing monetary policy, evolving industrial demand, and growing interest in hard assets. For precious metals investors, the lesson is simple. Never focus on price alone. Understand the forces driving the market, because those forces often begin changing long before prices fully reflect the new reality. The next several months could provide valuable insight into whether this Treasury sale was simply an isolated adjustment or part of a broader shift that investors cannot afford to ignore. The most successful investors understand that markets reward patience rather than emotional reactions. Headlines create excitement every day. Some appear dramatic for only a few hours before disappearing completely. Others quietly mark the beginning of much larger trends. The challenge is knowing the difference. That is why professional investors rarely make decisions based on one headline alone. Instead, they ask deeper questions. Is this event changing long-term fundamentals? Will it influence future monetary policy? Does it affect investor confidence? Could it alter capital flows? Will it impact inflation expectations? Could it change demand for safe haven assets? These questions matter far more than short-term price swings. Looking ahead, several indicators deserve careful attention. Treasury yields will remain one of the biggest signals. If yields continue climbing, investors will want to understand whether stronger economic growth or weaker bond demand is driving the move. The answer makes a significant difference for gold and silver. The US dollar will also remain under the spotlight. If the dollar stays strong, precious metals could experience periods of consolidation. If the dollar begins weakening because investors expect lower interest rates or changing capital flows, gold and silver could receive additional support. Federal Reserve communication may become even more important. Every statement from policymakers has the potential to reshape expectations. Markets often move before official decisions because investors constantly attempt to anticipate future policy rather than react after the fact. Inflation remains another key variable. If inflation proves more persistent than expected, investors may continue seeking assets that help preserve purchasing power. Gold has served that role throughout history. Silver often attracts additional investment interest whenever confidence in paper assets begins weakening. Industrial demand may become one of silver's greatest advantages during the years ahead. Unlike gold, silver is consumed in thousands of industrial applications. As technology continues advancing, demand for highly conductive materials may remain strong. Artificial intelligence, renewable energy, electric transportation, medical innovation, modern communications, defense technology. All of these sectors rely on silver in different ways. Even modest increases in industrial demand can become meaningful if mine production struggles to expand at the same pace. This is why many analysts continue watching supply trends very closely. Mining companies cannot simply double production overnight. Permits require time. Construction requires capital. Exploration carries uncertainty. Environmental regulations continue evolving. Labor costs remain elevated. Energy prices influence production expenses. These challenges limit how quickly global supply can respond. Investment demand introduces another layer. When confidence in financial markets remains high, investors often focus on stocks and growth assets. When uncertainty increases, many begin diversifying into precious metals. Gold usually receives the first wave of attention. Silver frequently benefits as more investors enter the sector. History has shown that silver can experience larger percentage moves than gold during powerful bull markets. Of course, the opposite can also occur during corrections. That is why volatility remains one of silver's defining characteristics. Risk management therefore becomes essential. Long-term investors generally avoid making decisions based purely on emotion. They build positions gradually. They diversify across different asset classes. They monitor changing economic conditions, and they remain prepared for both bullish and bearish scenarios. The current environment presents opportunities as well as risks. Government debt remains historically high. Interest rate expectations continue changing. Global economic growth remains uneven. Geopolitical uncertainty has not disappeared. Currency markets remain active. Inflation has moderated in some areas, but concerns have not completely faded. All of these factors influence precious metals. Japan's Treasury sale should therefore be viewed within this much larger context. It is one important piece of an evolving global financial picture. Whether it proves to be an isolated event or the beginning of a broader shift will depend on future actions by other major investors. China, European institutions, large pension funds, central banks, private asset managers. All will continue making decisions based on changing economic conditions. Markets will closely monitor those decisions. One trend that cannot be ignored is the growing desire for diversification. Many institutional investors no longer rely exclusively on traditional portfolios. They increasingly include commodities, precious metals, infrastructure, and alternative assets. This diversification reflects recognition that the global economy has become more complex than ever before. Gold continues serving as a trusted store of value. Silver continues offering both monetary and industrial potential. Together, they occupy a unique position that few other assets can match. For viewers of this channel, the most important takeaway is to stay informed rather than emotional. Understand the forces shaping the market. Watch the Federal Reserve. Monitor Treasury yields. Follow inflation data. Observe the US dollar. Pay attention to industrial demand. Track central bank activity. And never underestimate how quickly investor sentiment can change. Financial markets reward preparation. Those who understand the connections between bonds, currencies, interest rates, and precious metals often recognize opportunities before they become obvious to everyone else. The story surrounding Japan's Treasury sale may still be developing. Future economic reports could either reinforce today's concerns or ease them. Future Federal Reserve decisions could reshape market expectations once again. Future currency movements could create entirely new opportunities for gold and silver investors. That is exactly why staying informed matters. The next major move in precious metals may not begin with gold prices themselves. It could begin in the bond market. It could begin in the currency market. Or it could begin with another unexpected headline that changes how investors view the global economy. As always, we will continue following every important development and breaking down what it means for gold, silver, and your investment strategy in simple and practical terms. If you found this analysis valuable, make sure you subscribe to Silver and Gold Watch and turn on notifications so you never miss our latest precious metals updates. Leave a comment below and tell us whether you believe Japan's Treasury sale is a temporary event or the beginning of a much bigger global shift. If you enjoyed this video, please give it a like and share it with anyone who wants to better understand the future of gold, silver, and the global financial markets. Thank you for watching, and I will see you in the next video.